Chapter 2, Magic of Compounding. A small investor should first let his investments grow before he starts thinking of it as a money plant. If a person had invested 1 rupee at the time of Babur invaded India in the year 1526 AD, then on a nominal 3% rate of interest, it would have grown to 17.85 lakhs. At 4% CAGR, it would 19.73 crore. At 5%, 2085 crore, and at 6%, 210 2 lakh 10,841 crore. The ability of a rupee of investment to grow to astronomical sums of money over a period of time, even at moderate rates of returns, is known as the magic of compounding. Archimedes, the Greek scientist, had argued about lifting the earth through application of a moderate human force on a lever whose one arm was several 100,000 times longer than the other one. While the actual theory could be debatable, the spirit of the argument can be extended to the magic of compounding, which states that even small amounts of initial capital compounding at a moderate rates of return can over longer periods of times create a mountain of wealth. The origin of the magic of compounding is the following compounded interest formula that we were taught in primary school. P in bracket 1 plus r upon 100 raised to the power n. P is principal, r is rate of return, and n is number of years. We now reframe the equation. I 1 plus CAGR upon 100 raised to the power t. I is initial capital, CAGR is compounded annual growth, and t is equal to time, number of years. Initial amount. Unless an investor can bet enough, he does not get rewarded for being right as he normally ought to be. There are not too many instances in an investor's life where he would be right with his investment, so when he is the attempt should be to try and make the maximum out of it. Personally, more than 90% of my wealth has been generated from less than 10 stocks ideas only. Making meaningless and insignificant token investment that do not have the power to change the balance sheet of the person is only an ego message and does nothing to advance his process of wealth creation. A great idea does not come often, and when it does, the need of the hour is to bet big and hold it for the entire duration of the up move, as it is more profitable to be allocating large amount of capital on a moderately winning investment than it does to be betting with smaller amounts on a super sizzling risky venture, as betting too much on a hot idea comes with the risk of capital destruction, whereas with a moderately winning investment the investor can put larger amounts of money to work. CAGR. The entire investing community is fixated with the rate of return that an investment is supposed to generate over time. When this rate is equated in annualized form of periods exceeding more than a year, it is expressed in the form of CAGR. Most investors keep focusing on the CAGR as they are devoid of time and want to get rich quickly, because generating a high CAGR has the power to magnify a small investment I in the shortest period of the time t. The CAGR is the only distinguishing feature of an asset class and varies from one asset to another, while the initial capital that an investor brings to the table and the number of years that he intends to retain his investment are completely in the hands of the investor and remains the same for all assets. The rate of return is a market determined number and is unique to an asset type, whether stocks, bonds, metals, or real estate. The number of years. Generally, a new investor focuses only at the CAGR or the rate of return that an investment is expected to generate. He remains completely oblivious to the fact that it is possible to reach a predetermined number even at a lower rate of return just by staying invested a little longer or by starting early. There is just no substitute to starting early in the investment game, even if that means postponing the luxuries of life for a later date. Most people do not initiate their investment process till it's too late and thereby waste the first few crucial years, which gives them less time to compound their investment. An investment compounding at 20% CAGR each year for 7 years will take 9 years and 48 days to generate the same kind of money if the asset compounded at 15% instead of the originally conceived 20%. However, as investors want to compress the return in the shortest possible period of time, they fail to realize that to make a lot of money, an investor need not compound at the highest rate of return but just stay invested a little while longer. This number recognition of compounding the return with the tenure of investment presents that the first sign of mature investor. Achieving a CAGR of 20% for a few years is commendable work, but doing it for 6 decades makes up a Warren Buffett. The T therefore is the number of years that the amount is left to compound at and is as important as the CAGR, since the T is also the numeric that the entire expression is raised to the power of. The compounding table. Financial analysts are generally aware of the rule of 72, which indicates the number of years it would take for an investor to double up his capital is 72 divided by the rate of return. However, the above relationship is restrictive as it only talks of double, but investors who look for a more exhaustive relation can use the following table, which elucidate the concept of magic of compounding by expressing the interrelationship between CAGR and T. 12% रेट से 10 साल में 3.11, 15% रेट in 10 years 4.0 times, 18% रेट 10 साल में 5.23 टाइम, 20% रेट 10 साल में 6.19 टाइम, 26% रेट 10 साल में 10.09 टाइम्स, 30% CAGR 10 साल में 13.79 टाइम्स, 35% CAGR 10 साल में 20 गुना, 40% CAGR 10 साल में 28.93 गुना, 50% CAGR 10 साल में 57.67 गुना, 60% CAGR 10 साल में 109.95 टाइम्स। इसी को अगर हम देखें कि 5 साल में कितना होगा, 12% से 5 साल में 1.76 गुना, 15% से 2.01 गुना, 18% से 2.29 गुना, 20% से 2.49 टाइम्स, 26% से 3.18 टाइम्स, 30% से 3.71 टाइम्स, 35% से 4.48 टाइम्स, 40% से 5.38 टाइम, 50% से 7.59 टाइम्स, और 60% से 10.49 टाइम्स पैसा हो जाएगा. As an investor moves down the table, the gap for different values of CAGR and T widens quite significantly. For example, an investor that generates a 26% CAGR multiplies itself 10 times in 10 years, thus making it a 10 into 10 investment. Similarly, if the investment were to compound at 30% each year, it would grow a rupee of investment to 13.79 times in the same period, and at 60% CAGR, an initial investment multiplies itself 109.95 times in 10 years. Another way of using this chart is to search for the CAGR to get to a desired investment value on a specific T or number of years. As years are marked in the rows and the rate of return in the column, an investor who looks to increase his investment 5 times in 5 years can search for the figure 5 under the 5th row. Thus, the rate of return that matches his requirement is located within the 35% and 40% column. As between these two rates of return, a rupee of investment can grow to 5 times in 5 years. Similarly, an investor who intends to increase his investment by 5 times at 18% can check for the corresponding row in the years column that meets up to this requirement, which is 10. So an investment increase 5.23 times in 10 years. One of the interesting inferences that can be drawn from this table is that the time period matters as much as the rate at which money is compounded. There isn't just one winner in the investment game. The magic of compounding is much like the race between the rabbit and the tortoise that we were narrated in the primary school. The story goes that once the rabbit challenged the tortoise to a race, and halfway through it, the rabbit, having established quite an unbeatable lead, decided to take rest and, in his overconfidence, fell asleep. The tortoise, on the other hand, continued to roll slowly without stopping, irrespective of where the rabbit was. When the rabbit finally woke up, it was too late, as the tortoise has crawled over to the finish line. Unlike the rabbit and the tortoise, where only one of the participants could have won the race, the stock market can have multiple winners as well as multiple losers, as it gives all participants a chance to win or lose concurrently. The only one who lose are the ones who leave the game well before the finish line, as they find it difficult to survive the market for an extended period of time. This is also unlike a cricket match, where if Australia scores 434 runs in their allotted 50 overs, South Africa have to get 435 to win. It's not an event like the Oscar, where only one movie can win the title, and like soccer, where there can be only one champion team. It's only a binary 0 or 1. In the market, different participants having different CAGR can also win the game. If Warren Buffett's Berkshire Hathaway generate a CAGR of 19%, Michelle Sennett 24%, John Neff 13%, and Peter Lynch 29%, all of them were declared winners. But the biggest winner has been Warren Buffett, because he could play the game for a longest period of time. Though Warren Buffett worked with a lower CAGR, he really pulled it across because of his T, in spite of starting with a modest $10,000. I The T worked well for Buffett because he started investing at the age of 11 and now at 82 is still in the game with as much passion, vigor, and focus. So, whether an investor does a CAGR of 26% or 21% or even 15%, what matters is how long he can be at the game without getting pushed out of it. Investors should realize that this game is not about winners take all, but it's about survivors making enough. If a person can remain involved with this market continuously for 20 years with passion, commitment, and seriousness, he would see at least 3 bull markets and would make enough to reach the stage of financial freedom. However, if he thinks of compressing the time, he runs the risk of death by exhaustion. Compounding works only when an investor can avoid the negative years. Another interesting facet of using the magic of compounding to advantage is to keep the negative years at the minimum so as not to easily give away the return of the good years. One of the notable features of the Buffett partnership in the early years of its existence was its ability to outperform the market in bad years, where it kept losses in check. In the same way, an investor should understand that one of the key drivers to maximizing returns is to avoid the big mistakes. Compounding works best only when there is no down year. An investor should evaluate each investment opportunity with the twin aspects of investing, risk and reward. If the risks are higher, then no matter how big the reward are, he should sit back and introspect. Allocating small amounts will make negligible difference to the portfolio, and by buying more, he might put the good work of the previous year at risk. In this context, consider an investor who makes 40% in a row of 4 years, a normal feat in a raging bull market, and lost 50% in the 5th year, and even more normal even post the end of the bull market. This loss of 50% in the 5th year brings down his overall rate of annualized return or CAGR to just 13.95%. If, in the above example, an investor had just retained his wealth in 5 years with a 0% return, the average CAGR for the 5 years after having seen a 40% run for the first 4 years would have still seen 30.89%. All investors become careless and confident after 4 years of supernormal return, and in order to keep the momentum running, they move down the quality curve, buying low-priced stocks of inferior business with questionable management and debatable financials. In this endeavor, the investors take maximum risk at a time when he should actually be controlling risk. Hence, maximum damage occurs when the portfolio is nearer to its peak, which washes away all the good deeds of the past. In markets, speed overrules size. Most people look for the quickest money making stock and not the one which will make them the biggest gain. The best investment is therefore one which generates a higher rate of return on a large initial amount over longer period of time. Merely generating a high rate of return isn't enough. The broker client setup is such that if the broker prospers, the client suffers, and if the client prospers, the broker suffers.